Okay. A very good evening to you all, friends. I'm Sanjeev Singhal, Central Council member of the Institute of Chartered Accountant of India and Vice Chairman, Sustainability Reporting Standard Board. I am also the chair of the UNCTAD ISR 39 session. We welcome you to the webinar on transforming global sustainability reporting and assurance landscape. As you may be aware, that India is the proud host. India holds the G20 presidency, and the Institute of Chartered Accountant of India is the principal partner with CII in the B20. We are very happy, and we recently participated in the CII Partnership Summit, CII Corporate Governance Summit, and now we'll be participating in the CFO Summit. There's going to be series of programs, and India has got this opportunity to host the G20, and ICI being the partner of B20. It's a happy occasion for all. As far as the Sustainability Reporting Standard Board of the ICI is concerned, this was formed 3 years ago in 2020. And since then, Sustainability Reporting Standard Board has been at the forefront in the initiatives. Basically, Sustainability Reporting Standard Board has come out with the first ever assurance standard on ESG. We have also brought out the certificate course on BRSR, which is Business Responsibility and Sustainability Reporting. We have a standard on the GHG emission, which is a replica of the ISA 3410. But as far as our SSAE 3000 is concerned, it goes beyond ISA 3000 and enables expression of an opinion, limited as well as reasonable, on the BRSR, on the Sustainable Development Goals, etc. ICI has also issued the Sustainability Reporting Maturity Model. ICI has also issued the world's first ever 16 social audit standards, and we have come out with the Institute of Social Auditors of India. Now the social enterprises will be able to list on the social stock exchange and raise both zero coupon, zero principal bonds as well as equity. If they are a for-profit social enterprise, they can raise equity also. And if they are not for-profit social enterprise, they'll be able to raise zero coupon, zero principal bonds. SRSB has conducted massive capacity building. We have trained over 2,000 chartered accountants in the sustainability space. And the BRSR in India has become mandatory from this financial year for top 1,000 listed companies, which covers more than 95% of the market capitalization. From next year, the capital market regulator is proposing to make reasonable assurance of the ESG information in BRSR as mandatory. So basically, the proposal is that from next year, Shekhar, can I ask you to be on mute? Shekhar Jain? Shekhar Jain, can you be on mute, please?
Sorry.
So from next year, 250 companies are supposed to go for the mandatory reasonable assurance. A year after that, 500 companies, and a subsequent year, 1,000 companies. Please remember, these are the proposals on the core matrices of BRSR. So SEBI, Security Exchange Board of India, is seeking opinion of the stakeholders. And we are very confident that this will go through because we have already built the capacity in the system and we have the necessary bandwidth. So India is all set to be a world leader in the ESG space. And we are happy to announce this partnership of the Institute of Chartered Accountant of India in the G20 endeavors of the government of India. And we are very happy that today we have with us Mr. David Madden from IFAC, who is a Director of Sustainability Policy and Regulation, and Mr. John Bolton, who is a Director of Policy at the ICAW. Besides, we have Mr. Shekhar Jain from CII, and Mr. Shailesh Tyagi will also be joining us as a technical speaker. The President, Institute of Chartered Accountant of India, is also likely to join shortly, along with the Chairperson of the Sustainability Board, C.A. Preeti Savla, and the Vice Chairperson of the PRC Committee, C.A. Shridhar Mopala. So basically, the sole objective of the Institute of Chartered Accountant of India Sustainability Board is to build a healthier, happier, and safer planet. If you look at News Times of India, it says that it's a matter of time, and definitely within 2 decades, the world temperature will rise permanently to plus 1.5 degree and bring massive disaster and destructions. So the clock is ticking very fast, and it is ticking for sure. It may happen that by 2030 we breach that 1.5 degree, and as I said, it's going to be permanent. So this is a cause for the real alarm and a real alert. We have to see as professionals what can we do to save our planet Earth. And for that purpose, we are talking about the global sustainability reporting and assurance landscape so that the corporates can contribute their bit. So I would like to invite our learned speakers to give the global perspective from their jurisdiction point of view. And I would like to start with John Bolton. And I know that both the learned speakers from ICAW and IFAC, with great difficulty, they have been able to accept our request at a very, very short notice. We're extremely thankful to both of them and all these speakers. And may I now invite John Bolton, who was in India very, very recently last week, and I had the opportunity to share the dais with him in the CII Partnership Summit. Thanks, John, for joining, and over to you for your deliberation.
Well, thank you very much, Sanjeev. And I'm going to share my screen now. So can I ask, can you see my slide?
Yes, we can see your slide.
So the slide is titled "Why Measure Emissions?" So I'm honoured to be invited by Sanjeev to speak at the webinar today, and I was at the B20 Partnership Summit in Delhi last week, where it was a real honour to be able to speak and to meet so many professionals in India. I've been really inspired by the example that India is setting in their roadmap towards the BRSR reporting, which is becoming mandatory this year, and the scale of transformation in terms of how the profession is supporting the ESG transformation has been a real source of insight to me. So I was very interested to speak to a number of professionals and ICAI members in India last week about that. What I also learned was the context in India is very specifically around the great steps the government has made around the CSR requirement in company law, but puts CSR at the heart of companies, I suppose, governance and strategy in terms of having to allocate a proportion of profits to CSR, which I think brings a level of corporate awareness of these issues, which is an important defining factor. We don't have an equivalent to that in the UK. So I think from an Indian context, the importance of the social element of that and the commitment of companies to making that CSR commitment is a really important dimension. So I'm going to illustrate a UK and a European perspective to these issues, which hopefully will give some context to the BRSR reporting in India and help you to understand what's happening around the world, which you may be exposed to if you're involved in a multinational organization, or just for your own personal interest in terms of understanding the context for some of the reporting that you're seeing. From a UK perspective, the ESG, so environment, social and governance reporting, has been very much driven from a climate perspective. So the commitment of the UK government to a net zero by 2050 has been the defining factor in terms of how we make that transition in the economy and how corporates, how companies can make a contribution towards meeting government's objectives. So you can see from the slide here that climate in terms of emissions per person on the planet and how those are contributing to the overall level of carbon in the atmosphere varies significantly from country to country. And in India, among the G20, emissions per capita are much lower, probably the lowest among the G20 nations. Now, from a UK perspective, we've already made significant steps towards reducing our carbon footprint. The amount of carbon in the environment already existing from emissions in the UK clearly has made a sizable impact. But the UK has made significant moves towards decarbonising through, in particular, closing coal-fired power generating capacity and shifting to renewables in terms of offshore wind. The moment, the big hurdle towards further reducing carbon emissions is the fact that around half of emissions are from gas boilers, which are a relatively cheap form of heating. And to remove that, those are installed in everybody's individual house. So to remove that further is quite a significant step. So this is where the corporate reporting comes in, because it's by mapping and charting the individual contribution of each company to that, I suppose, carbon footprint of the nation that enables government to understand and track actions that can be taken to reduce carbon emissions overall. So at the heart of the UK's ESG reporting has been reporting on your carbon emissions and helping government to meet its net zero commitments, which we'll come on to in a minute. But carbon and climate are by no means the only dimensions in reporting. There are a number of other government objectives and social objectives which this reporting is aiming to achieve as well. So key components in the landscape include gender pay gap reporting, and also reporting on modern slavery in terms of supply chains and treatment of labour within supply chains. Government has international commitments and policy objectives in those areas, and it expects corporates to do its part in meeting that reporting. So what's the current ESG reporting landscape in the UK? Well, this is very much framed by the Companies Act. So the Companies Act 2006 has Section 172, which requires companies to report on what they do, the impact of the business on the wider stakeholder group. And this, although it's a very brief reference in company law, below this has been a whole suite of reporting requirements that have started to come into play since 2018 in particular. So we have Section 414, CB and CA, and those sections of the Companies Act have regulations below them which require companies to, in demonstrating how they've met their Section 172 duties, to report on a variety of other metrics about the business's impact more widely than its, I suppose, generation of profits. The reporting that's currently required is to the extent necessary to understand the company's development, performance and position. So it's very much through a company lens. This is company reporting on the performance and position of the business, but it's bringing in the impact of these wider factors and how those contribute to company performance and its impact on that wider stakeholder group. And it's important to note the phrase here, to the extent necessary. So there's a materiality threshold here, which is an important dimension for the accountant. So you are required by law to report on, to the extent necessary to understand those things, with those caveats, to report on environment, employees, social matters, and then specifically respect for human rights, and your anti-corruption and anti-bribery efforts. What you're required to report on are your policies in these areas, any due diligence that the company undertakes in that regard, and the outcomes of those processes. So there's potentially quite a lot of reporting there, but bear in mind it's with this materiality threshold and from the perspective that I've described. You're also required to report on principal risks and their management. So that materiality perspective means that what we're reporting on here is a company's ability to deliver its strategy and its ability to generate sustainable returns for shareholders. Now, the extent to which companies have disclosed around these metrics has very much depended upon their size and public profile. So if they're a listed company, the corporate governance code has required a higher level of expectation around these areas. and there is government guidance to help you understand what you ought to be doing in these areas, as well as a level of peer pressure and regulatory interest in terms of the expectation of what you're required to do. So I think what I'm saying is, although the base is in company law, the reality of this is very much the largest, most high-profile public companies have very much been taking the lead. So the reality of it, although there's a regulatory and a legal framework, it's been market-led as well. Now, as well as that company law requirement, we've also got in law a requirement for reporting on modern slavery. So this requires reporting on the structure of the organisation, its supply chains, policies on slavery and human trafficking, details of any due diligence conducted in supply chains, risk assessment, management of risks, and the reporting of key performance indicators. So quite a bit of reporting there around supply chains, but it's very much within the framework of what the company does and how the company responds to these risks, rather than an absolute liability for the company to have conducted, for example, supply chain due diligence. And that's an important distinction. Also important to note in the right-hand column here that the thresholds for this reporting are quite disparate. So whereas the Companies Act requirements apply to the largest companies, those with employees over 500, with differential incremental reporting for the listeds, the Modern Slavery Act applies to those with turnover over £36 million. So that's a lower threshold. We've then got gender pay gap regulations, which require the reporting of the 6 metrics you can see here on the slide. So 6 specific metrics around the gender pay gap. And that's being reviewed at the moment to see whether there are additional metrics that should be reported on. And that applies to businesses with employees over 250. So again, a different threshold. As you get down to the smaller end, there's a very different set of requirements that potentially apply. So if we come back to carbon reporting, so you may be familiar with the Task Force for Carbon-Related Financial Disclosures, TCFD. It's an organisation that's headed by Mark Carney, former Governor of the Bank of England, and that's had a significant impact on the UK environment. So TCFD disclosures became mandatory last year for standard and premium listed companies. There's a stock exchange requirement for reporting in line with the TCFD. And that means reporting on how the company is managing climate-related financial risks, governance, strategy, risk management, metrics, and targets around that. So what we've seen is a real step change in the level of disclosure around the carbon impact of listed companies. Again, now, the scope here is quite specific. Then in the company law, earlier from 2019, there's been already a carbon reporting requirement. So this is legislation called the Streamlined Energy and Carbon Disclosures, and that has required disclosure of all the Scope 1 and Scope 2 emissions. So all of the carbon emissions that a company is responsible for. And there's some very detailed government guidance around how you calculate what your emissions are. Requirement for an intensity ratio, a comparative to the previous year, as well as an explanation, and this is important because it gets very complicated, an explanation of the methodologies that you've used. And that's applied since 2019 to quoted companies and large privates. So that's already there in the law. The law is being extended this year, so there will be more detailed and extensive carbon reporting coming into the law for all those companies that are subject to it. We've then got a suite of additional requirements which are going to come into play in the UK. So we have building on the carbon reporting that is already there, transition plan disclosures. So this is an ambitious effort by the government to make companies report on their plans to decarbonise. So their ambitions to mitigate, manage and respond to climate change, not just how they're going to reduce their emissions, but how they're affected by global warming and climate change. Their actions in the short, medium and long term, the financing they have in place and are required to, are going to need to have to do that. Governance and accountability around this. You'll have seen that from the TCFD requirements. and measures to address material risks and leverage opportunities that climate change presents. So you can immediately see this goes significantly further than the TCFD reporting, and it's quite specific in its requirements. Now, the government is clear that this is kind of a building block. So, and I'll come on to international sustainability reporting standards in a minute, but this is a UK government requirement that builds on top of international reporting that businesses may have to start doing in the future. So the two are moving in tandem. And if you remember back to my first slide, this is where the government policy comes in, that this is all about understanding the level of carbon and what can be done across the economy to reduce carbon emissions. The final piece in this jigsaw are international sustainability reporting standards. So we're expecting later this year the first two standards to be published, one on general disclosure and the second on climate disclosures. We expect that the international standard on climate will be consistent with the TCFD. So companies that are already doing TCFD will already be starting to do this, but it's going to have specified more granular disclosure. I mean, as I mentioned in the UK, we're going to have this incremental task transition plan disclosures that will then add on to the top of that. And there'll be a suite of further international standards. I think the next one's biodiversity, that will build on that and provide disclosure around a range of other areas. UK government is committed to introduce international standards. That's what it said. It's supportive of it. It said publicly it's supportive of international standards, but the mechanism by which they're introduced into the UK has yet to be established. As an expectation, it will be an endorsement mechanism to review those standards and then endorse them for use in the UK. The scope for both transition plan disclosures and international standards has yet to be set, so that remains uncertain at this time. Final dimension I wanted to cover for you is the European Union. Now, to a certain extent, individual countries are as very positive. There's a level of competition to introduce change and disclosure as soon as possible. So the European Union, as the UK left the EU, a couple of years ago, is following already a different direction and is very keen to show leadership and implement its own sustainability reporting requirements. So there has already been published by the EU Corporate Social Responsibility Directive, known as the CSRD. That was published in December last year. It's going to be applied in 2024 for reports published in 2025. So this is moving at a fast pace. Now, the features of that are particularly important are that this is going to apply to large private companies. It's not just listed, so it massively increases the scope of sustainability reporting in the EU. It catches at quite a low level. I think it's 150 million euros of turnover businesses that have operations in the EU. So large Indian businesses that are providing services into the EU may well have to report under this. It requires reporting under a suite of EU sustainability reporting standards I'll come on to in a minute. And crucially, it requires assurance. Like the BRSR in India, there will be an assurance requirement with the CSRD, which is going to be introduced a little bit later for limited assurance, and then a couple of years after that, by the end of the decade, reasonable assurance. And they're working at the moment on an international standard for assurance. It remains to be seen what standard will apply to the assurance that will be provided in the EU. That's in development at the moment. And measures to educate the assurance providers are also being developed on a member state by member state basis. And there will be digital tagging of these. There is then to accompany that a whole suite of European sustainability reporting standards. And I've listed them on this slide. You can see they cover a very wide range of matters. They go significantly beyond climate, cover pollution, water use, biodiversity, and then social measures, including workforce, the value chain, affected communities. A lot of stuff here, and a suite of standards in development with industry-specific metrics. So very wide range of metrics and disclosures that would be required in Europe. Standards have not yet been adopted. They will be consulted on again in a month's time. The expectation is the first suite of standards, which are those on the slide, will be adopted in June. but that decision has not yet been made. I'll just finally mention in the EU, there's also a piece of legislation around supply chain, corporate governance, corporate sustainable governance directive. So there's another piece of legislation has not yet been finalised, but the idea for that would be to give a level of responsibility to directors of their supply chain, requirement to do due diligence on the supply chain to make sure there's no human slavery or abuse of human rights happening throughout the supply chain. Big new level of corporate responsibility, and that will have a level of reporting associated with it as well. There are also taxonomy disclosures in the EU, so requirement to report on the proportion of turnover and profits and assets that are from green activities according to the EU taxonomy. So a range of things there in the EU. As I say, the regulatory framework is becoming quite different between the UK and the EU at the moment, but a lot of moving parts and clearly a lot of change in the years to come. Thank you.
So thanks a lot, John. This was quite informative. So we really thank you for sparing your valuable time. And now, may I now invite David. David has been a friend of ICI for long, and when Sustainability Board was formed in the initial years, also David, on our request, has kindly accepted to be a speaker. Once again, we reached out to him on a very short notice, and he has accepted our request. I would request David to share the global perspective on this topic. Thank you, David, and over to you.
All right. Thank you, Sanjeev. Thank you, John, for leading us off. And hello, everyone. Good evening. It's good to be here on behalf of IFAC. I appreciate the opportunity to present on a topic that has really been a priority for IFAC's policy work and advocacy over the last 3 years. And it certainly takes up most of my time day to day. And that's, the reporting and the assurance of sustainability information. As John has just highlighted, much of the attention has rightfully been on the standard setting process for how companies report on ESG topics. But I'm going to bring more of an assurance lens, because I think from IFAC's perspective, corporate disclosure on ESG cannot really be at the same level of decision usefulness as financial information without assurance. So I'll focus on the assurance and sustainable information, and I'll provide some highlights for research on the current state of play from a report that IFAC and AICPA CIMA just published last month. It's the third in a series of reports that assesses how much sustainability assurance is happening, who's performing these assurance engagements, and what standards are being used in these engagements. So it is the third report in a series. So we have a 3-year trend line for tracking activity on a global basis in 22 jurisdictions and about 1,400 large stock exchange listed companies. I have to note that in last year, when we were conducting this third analysis, we had difficult accessing with sufficient completeness information from the 50 Russian companies that we typically include in this study. So for 2021, our data is 21 jurisdictions and 1,350 companies because of the Russia factor. And Sanjeev, you have some slides for me. If someone could share those slides, please.
David, I'll just see actually the person who was looking into it has got a medical emergency and he's not there. If you make your host, is it possible for you to share the slides? David?
Yeah, I don't think I can do that given my setup here. Let me try.
Okay.
Hold on. Yeah, I'm not going to be able to do it.
Just a minute. वहां से हो जाएंगी क्या भैया? वहां से हो जाएंगी तो मैं किस पे भेजूं? पेन ड्राइव नहीं चलता, मेल बताइए. मेल बना दीजिए. Yeah. So we are sharing your slide, David.
Okay, so just give it another minute or so.
Yeah. Less than that.
All right, so Sanjeev, why don't I just continue and I can talk through some of the points, and then when the slides come up, I think they'll be helpful. So I'd like, what I typically do is start out with kind of a global scorecard. So I'll give you some of the highlights from what that global scorecard shows in terms of reporting and assurance on ESG. So over the last 3 years, we continue to find more and more reporting on sustainability. So in 2021, 95% of the companies that we examined reported some sustainability information in their 2021 disclosures. In fact, there were only 4 jurisdictions.
So David, have you shared 2 PPTs?
I'm sorry, Sanjeev?
Have you shared 1 or 2 PPTs?
1.
There is a PDF. Yeah. ये PDF ही है यार.
Yeah, it's a PDF.
Yeah. Yes, David, please go ahead.
There we go. And if we can turn to the next slide. 1 back. There we
David,
go.
this is the opening slide.
We're all set. So sorry for that technical difficulty. Very much appreciate it. So I was talking about the 95% of companies that are reporting. Only 4 of the jurisdictions that we examined, Argentina, Mexico, Saudi Arabia, and Turkey, actually were meaningfully below the 95%. So a broad-based reporting across the sample. So while the incidence of assurance that you see there of this information definitely lags reporting, there is a clear upward trend, right? From 51% in 2019, we now have 64% of companies that we reviewed obtaining assurance in 2021 over at least some of the information that reported. Assurance is limited in nature, consistently around 80%. Audit firms are still conducting the majority of these ESG assurance engagements globally at 57%, but that means 43% of engagements are being done outside of the accountancy profession, and the trend has certainly not been in favor of accountants. We're finding that as companies obtain assurance for the first time, it is greenhouse gas focused, and they are turning to consultants for verification of those metrics. For example, that was particularly true in the UK, South Africa, and Japan in 2021. When firms are engaged to do assurance, they're overwhelmingly using IAASB standards, which is ISSA 3000 revised. That's 95% of the time for firm engagements. But when consultants are doing sustainability assurance, only 38% of them are using ISAE 3000. So the next slide, please. So as we all know, high quality, consistently applied standards and frameworks for how and what information is reported really provides the best foundation and the suitable criteria for high quality and consistent assurance. The problem is that today, most of this ESG reporting is still voluntary. And in 2021, the number of companies using a mix of standards and frameworks for their ESG reported continued to increase. It's now at 86% of the companies that we examined. That's almost a 20% point higher number than in 2019 when we first did this analysis. In India in 2021, 64% of the 50 companies we reviewed used multiple standards for reporting, and GRI and the SDGs were the most popular. So our profession, I think, also understands that where and when information is reported also matters. So if I could have the next slide, please. With respect to where, the 3-year trend is away from standalone sustainability reports and towards annual reports and integrated reports. In fact, we saw a 7% drop from 2019 to 2021 in the use of standalone reports. 30 of the 50 companies we reviewed in France now include their ESG information in a report that is consistent with the integrated reporting framework. Over the 3 years, integrated reports increased significantly in Brazil, Japan, Turkey, Singapore, as well as India, where over the 3-year period, we have seen a 21% increase in the reporting of ESG information in integrated reports from Indian companies. Only slightly over a third, 36% of Indian companies we reviewed reported in standalone sustainability reports. That's significantly different than some jurisdictions in the rest of Asia and in North America, Canada, and the US. So this is important. Where you report is important also in terms of when the information is reported and assured, because we find that there are gaps in time between when the financial audit opinion is issued and the issuance of the assurance report on ESG. And we think that that gap in time serves as a proxy for how well sustainability information is connected with financial information. So, for example, this gap is about a week in the EU, where most ESG information is in annual or integrated reports. It's over 90 days in the Americas. That's driven by the US and Canada, where standalone reports are the dominant form of sustainability disclosure. But the gap in Asia Pacific dropped from an average of 73 days last year to 61 days in 2021. And that was driven by big improvements in shrinking that gap in India, Indonesia, Japan, and South Korea. If I could have the next slide, please. So now let's take a bit of a deeper dive on assurance. If we go to the next, there we go. In 2021, the biggest increases that we saw in assurance rates were in Hong Kong SAR, Japan, and the UK. Over the 3-year period, 2019 to 2021, again, Hong Kong SAR experienced one of the largest increases, along with Singapore, Japan, Turkey, the UK, and Italy. Of the 913 assurance reports reviewed from 2021, as I said before, 57% resulted from engagements conducted by audit firms, but there were big differences between jurisdictions. So, for example, in France, audit firms have close to 100% market share. In South Korea, where there is a very high level of assurance, the market is dominated by other service providers. And while these other service providers or consultants are doing ESG assurance in virtually every jurisdiction we study, there were 7 cases in 2021 where more than 50% of assurance is being provided by consultants. And that took place in the US, the UK, Hong Kong, India, Japan, South Africa, and South Korea. ISAE 3000 is the dominant standard. It's been hovering around 70% over the 3-year period. However, we see a big divergence in practice between accounting firms and other service providers. That's the 95% versus 38% number that I referenced earlier. Next slide, please. So as a result, we're also seeing a divergence in the level of assurance provided. So for the second year in a row, in 2021, when firms did assurance, 97% of those engagements resulted in limited opinions. When consultants were engaged, 58% of engagements resulted in limited opinions, 22% were moderate, 15% were reasonable, and 5% were something else. So it's important to note that in spite of the wide use of ISAE 3000, the IAASB is meeting actually here in New York today. I'm in the office for that meeting. The board is developing a new, more ESG-specific assurance standard for use by all types of practitioners, accountants, as well as consultants. It will be applicable to ISSB standards, as well as other reporting frameworks, including those in India, also the ESRSs in the EU, GRI, and others. And IFAC, I have to say, strongly supports this new standard as a global baseline for broad scope sustainability assurance engagements using what will be ISSA 5000. And that standard is expected to be exposed for comment later in 2023 and finalized and published late in 2024. The next slide, please. So here we take a look jurisdiction by jurisdiction at who is providing assurance, accountants versus consultants. And the gray lines are the other service providers. Among the EU countries in our study, virtually all of the companies we examined relied on the accountancy profession. Australia is pretty close at 95%. But if you look at the right half of this graph, we see a different story. From South Africa to the UK and across Asia, consultants dominate the practice. So consultants clearly have a strong foothold in certain jurisdictions. And we think it's important to understand the dynamics that are at play in each jurisdiction and to evaluate as a profession whether the evolution of ESG reporting, specifically broader scope and mandatory requirements, will provide an opportunity for an evolution in who companies choose and what their commercial motivations are for companies to choose who will provide their sustainability assurance. And one more data slide to share with you. When we look at the use of, if we can just go to the next slide. When we look at the use of standards by audit firms from 2019 to 2021 on the left, we see the dominance of ISAE 3000 in these engagements. On the right-hand side, we see a different picture. And this is where standard fragmentation is happening, with consultants using a mix of standards for different types of engagements in different parts of the world. So ISO standards being used for greenhouse gas metric verification is most common, and it's on the rise. 3000 is in second place, signaling broader scope engagements being done by consultants. Accountability 1000, the purple bars, has a meaningful market share. It's also used for broader scope engagements, but it hasn't been growing as much. The next slide, please. So once we published our first research report on 2019 disclosures, we conducted extensive engagement to try to understand the jurisdictional differences that we were seeing. The result was what's pictured here, IFAC's recommendations or vision for high quality assurance and sustainability information. It was based on the emerging best practices we observed, and it's predicated on the use of high quality global standards. So now, after a third report has been published and a lot of evolution in the marketplace and the work of the IAASB on this new standard, ISSA 5000, we still think that our vision or our recommendations that we had back in 2021 still are very much on point. So I'll highlight 5 of them. First, we believe we need regulatory requirements for mandatory reporting and assurance, requirements that result in broad scope, truly decision useful information, and not a tick the box compliance approach to reporting or assurance. Second, we think that information silos that can exist within companies need to be broken down or bridged so that there is alignment between sustainability disclosure and financial reporting with a focus on the integrity of the data, systems, and internal controls. Third, directly related to the previous point, and most important, is connecting assurance of sustainability information with audit of financial information. We believe this maximizes the value of assurance to both companies as well as to all of their stakeholders. Fourth, everything we believe rests on a foundation of high quality global standards that minimize standard setting fragmentation, therefore reducing cost, confusion, and complexity for everyone. And then finally, we think that regulatory supervision and enforcement over assurance must ensure uniform application of standards by all practitioners, all providers of assurance, be they audit firms or consultants and other types of service providers. And now the final slide to wrap up. As the reporting of sustainability information and its assurance moves from voluntary to mandatory, IFAC believes that our profession must and should unite behind ISSA 5000 as a global baseline standard for assurance engagements. We need that level playing field, so compliance with independence and quality control requirements, for example, on all practitioners is important. But at the same time, we have to acknowledge that these other service providers or consultants are a meaningful part of the assurance ecosystem, but we need to try to minimize fragmentation of standards. And finally, IFAC will keep benchmarking progress over time, and we're expanding our analysis of the G20 plus Singapore and Hong Kong to include an additional 20 jurisdictions, which will be 7 additional jurisdictions in Europe, 6 jurisdictions across Europe and the Middle East, across Africa and the Middle East, 4 more jurisdictions in the Asia Pacific area, and 3 more jurisdictions in Latin America. We hope to publish that research in May or June of this year. So with that, thank you very much for your time and attention.
Thank you, David. This was pretty useful, and I agree that we need to have one assurance standard. And similarly, as far as reporting is concerned, we are of the view that that there has to be a real integrated report, wherein the financials and non-financials are given side by side, rather than having different set of the financial statement and a different set of the non-financial statement. And in order to be meaningful, it has to be simple, brief, concise, and to the point in order to serve the real purpose. And in India, BRSR is one example which serves the purpose. And at the Institute of Chartered Accountants of India, we're trying to work on a unified standard of reporting, which incorporates both the financial as well as the non-financial reporting. So thank you very much for an insight. I'll request office to take off the presentation. With now, I move to Mr. Shikhar Jain from CII, and I would request him to give an overview, a detailed overview of the BRSR requirement in India and any other update that he wants to share. Shikhar Jain has been a Shield panel member of the Sustainability Awards in India, and at the same time has been a special invitee to the Sustainability Reporting Standard Board. Shikhar, we value your time and we value the relationship of CII with the Institute of Chartered Accountants of India. Thank you for being here, and over to you.
Thank you, Sanjeev ji, for inviting CII. And I think whatever I have to speak, both John and David has already sounded on that. And I need to, although this is the webinar on assurance largely, but I need to assure everybody that India has come on board with the international standards, and we are at par now. Last 5 years, starting 2017 to 2022, I should say that the complete landscape of ESG reporting has largely catched the sort of pace with what the global companies had been doing. And I think during the COVID times, we have a great initiative that ICAI, under leadership of Mr. Sanjeev Singhal, took with the constitution of SRSB, Sustainability Reporting Standards Board. And silently, this board has done a couple of things, which we will also cover once I go along with what I have to present. Thanks again, ICAI, for inviting CII. And as Sanjeev ji mentioned, that ICAI is a very important representative to us in our B20 initiative, because at the same time, in this presentation, I will use 2-3 hats that we are wearing, or I am wearing at CII, that we are also the B20 secretariat, where ICAI is a very important contributor to us. And both John and Mr. Sanjeev were in the meeting room where we discussed about the future, how it transforms. And I think the discussions are going along on that. Second important point is, in my presentation, I will like to give you India landscape, that what is happening in the ESG. And then towards the end, of course, on the assurance standards that I have heard both John and David, in India, Sanjeev ji will say that we already have the assurance standards that have been sort of developed by ICAI. And definitely it will come for testing once the companies start reporting on the BRSR part. So with this in the background and the context that already the co-panelists have set up, I will just go fast with the presentation because most of the things would be known to people, but still from CI perspective, I would like to update on the same. So if you see in Indian context, one thing that completely changed from 2017 was that most of the companies have been doing sustainability reporting for some time from 2010 onwards, I should say, based on the GRI standard. But then we saw from 2015 that there was a transformation going on, and this transformation got sort of converted into the companies graduate from sustainability reporting to ESG reporting by following varied standards. It could be either GRI or it could be IR, which is integrated reporting, or some other standards. But largely, then we saw the discussion that went around along with Ministry of Corporate Affairs with coming out with responsible business conduct guidelines, which I will share in my presentation. And I think that set the pretext for the companies now to adopt a very structured approach when they are doing their ESG disclosure. So if you see from Indian context, there are two things which are happening. One is that the capital markets are recognizing ESG, which is more a risk-based approach where they want better disclosures to be done by the organizations. And I think both the co-panelists have already said that for ESG from the investor's perspective, I think this became a very important part because the quality of disclosures have to largely improve than what we have been doing in the sustainability reporting, which was more narratives and all that the companies were doing. And I think once the capital market started recognizing the ESG performance, it became a sort of a competition in India because most of the companies which have a higher market cap and also the top 1,000 listed companies, there is a bit of competition which will obviously convert into valuations down the line in 3, 4, 5 years. But already we have on the Indian Stock Exchange Nifty ESG index, which is also there. So at least ESG related products got made in the capital markets, and that's why the mutual funds which are there. Which are having the ESG as the subject matter. So they are also investing in those companies. For the companies, for the first time, they also realize that ESG is also not only to be looked from the sustainability or only from the greening part, the environment and the social, but they connected this to the business continuity. And I think this is the most important learning that I can say from CII perspective, that industries started looking ESG from the point of view of impact that it can have on the business continuity, financial performance, and it may serve as an opportunity for the business for future growth. And I think that compelled the industry that we have to take time-bound actions, and that's where this complete narrative of ESG changed in India in last 4 or 5 years. One is the ecosystem in which the capital markets sort of came out with BRSR, and also the companies realizing that this is a business continuity issue, not only learning from the disrupted supply chain during the COVID times, but otherwise the issues that already have been discussed on climate change and human rights and global value chains getting integrated with the foreign brands in the country. The confusion now comes at the second level in India is that there is a confusion between the ESG matrices, which is followed by the rating agencies, because all of a sudden we saw in India that there was a huge proliferation of the rating agencies which started rating the ESG performance. And I think that for the companies were again a sort of an eye-opener, because these matrices were different by different rating agencies, whether it is CRISIL in India or DJSI or MSCI, FTSE, and they have different rating because of the weightages that they have given to ESG. And that's why the companies were confused, and they were more on the confusion, and that confusion still persists in some of the companies, that what is the actual ESG matrice on which we will be rated. So in order to sort of remove that confusion in the Indian ecosystem on the ESG, SEBI came out with a guideline, the consultation document for the ESG rating agencies and also for the so-called the investing companies like mutual funds and the investors. So I think this sort of situation will now be handled in a more sort of a standardized approach, because BRSR becomes one of the key requirements in which even the matrices have to be developed, because most of the Indian companies were rated on the matrices that have been there global in the nature. Nobody is doubting on that, but some of those indicators really don't apply in the Indian conditions, and climate being one of them, because where the country has a roadmap of adopting NDCs and going in for 2070 as a net zero country. And so there were various narratives to it, which has to be customized as per the Indian requirements. Similarly, there is a lot on the ESG disclosures, which we have already discussed, on GRI to IR to BRSR. And one thing that was strategically missing in most of the Indian companies was an inherent ESG framework within the organization. So the companies have been looking for a framework for assurance also that covers that, okay, how good are the internal processes, how good is the results coming in from those disclosures, and how these matrices externally that the rating agencies are using get rated on. Because in India, all these three things somehow had different perception. So the companies were doing the framework internally based on like somebody mentioned, on the ISO standards or other standards. ESG disclosures were on GRI, matrices were based on some foreign standards. So I think this is another issue that got sort of resolved, I should say, in last 1 or 2 years. And again, ICAI played an important role, because the SRSB came out with something called as the gap assessment that could be done with the BRSR to let companies know where they are. And as the vice chair of SRSB mentioned, that there had been more than, I think, 2,000 or 3,000 chartered accountants already trained through these type of trainings that were conducted. So I think that removed some ambiguity, but still it will pertain. But I think that is what even we are looking at CII level, that how we can work more closely with ICAI and SRSB, and also try to showcase that when we are the secretariat to B20, that what is that we can learn from the world, and what is that the B20 India can give to the world from the point of view of what we are doing as a landscape within India on ESG. And I think all of you are aware of this. So the various rating agencies, the matrices that are followed in India had been Bloomberg, had been MSCI, Dow Jones, EcoVadis. And I think that created a lot of confusion, because Indian companies were not aware that who is rating them on what, and one particular rating is on a higher side, other is not so good. So I think these standardization also requires looking into consideration the geographical importance when it comes to the material aspects. And I think these are the disclosures which the companies have been working on, as I said, GRI, TCFD, CDP, but then BRSR. And one important document that I will like to discuss over here is the National Guidelines on Responsible Business Conduct. And I think as John mentioned, from the perspective in UK, the regulatory requirements which are there for the disclosure, I think in a similar way, Ministry of Corporate Affairs in India came out with this with so-called the set of guidelines and principles. I think what has happened in Indian context is that most of the companies and the rating agencies have jumped down to BRSR, and they have not understood that BRSR is a subset of the guidelines that have been issued by the Ministry of Corporate Affairs. And here is the crux, because it gives you all the requirements that have been built it up. And the uniqueness of National Guidelines on Responsible Business Conduct is that as I think David or John mentioned that in India, we regulated on the CSR issue. But then these guidelines also talks about SDGs. It talks about various other reporting parameters. And I think most of them get covered over here. So I think in a way, NGRBC in India comprises of all the applicable international standards which were there till 2019 and which ministry had looked in with the committee that they have. And once this document was ready and released by the Prime Minister, I think that's where the market regulator SEBI came in and sort of prescribed the requirement of business responsibility and sustainability reporting. So that's what the connect between the BRSR and the NGRBC is. And I think what further happened in India during last 4 or 5 years have been is that there is a lot of investors, regulators, asset managements, companies which came in India with the ESG specialized products. And that became most of the push factor for the companies to start adopting ESG. And more important is not only the adoption, but the third party evaluation of that. And I think, as David mentioned, that in India, till the time ICAI came out with the assurance standard, in India also the business on assurance is a bit unregulated in the field of sustainability and ESG, where most of the certification bodies in India have been doing the assurance based on accountability AA1000 AS and other standards of the protocols that the certification bodies have developed. So I think these were some of the issues which led for the assurance practices. So this is what I was saying, that the national guidelines on the responsible business conduct, if you see, has already taken into consideration the UN guiding principles on business and human rights, on SDGs, on the Paris Agreement, taken ILO into consideration, the Companies Act. So this is in itself a very important document, which I will request not only the people in this webinar, but also otherwise, that we should go into this and understand that what the ministry has prescribed, and then the disclosure requirements are in BRSR, and then ISAI SRSB has proposed certain assurance standards. So there is already a framework in place. It's the matter of how the implementation starts on this. And good part over here with the NGRBC, which is also a part covered, is that they are very well covered with the SDGs mapping. And I think that is what India's commitment is, that by NGRBC, we are also connecting it to the Paris Agreement requirement of NDCs, the nationally determined commitments that India has given for climate change. And also, how do we meet the SDGs by 2030? So this is how the format of BRSR is also prescribed, which has 3 sections, 9 principles, 2 indicators. And I think as Sanjeevji mentioned, that this is the test for us, because this is the financial year when 1,000 companies will be reporting on this, which is still not to be assured this year. But I know that some of the companies might go proactively, as they have done in the previous year, and disclose the information on BRSR. I assume that there would be a handful of companies which will be using certain assurance standards, definitely, because in IR also, in the integrated reporting, they are using certain standards for assurance, which is ISA 3000 and other standards. So definitely this will have a good pick. At CI level, what we have done to support our membership over here is that we have developed some tools on ESG intelligence and analytics, which lets company know that where they are, which are on the diagnostic tools and the ESG assessments, benchmarking it with their peers in the market, covering the material aspects which are there in the Indian context. So at least we can help the companies to build up their materiality metrics from the environment and social point of view. And in our experience, we saw that most of the rating agencies widely had been rating some of the Indian companies, or largely the companies, low on the governance part. So I think that is also one of the learnings from CI perspective, that how do we improve the overall governance, wherein the board becomes very important decision maker also on the social and the environmental part from the point of view of risk management, business ethics, transparency, and the tax strategy point of view. So this is what one of the services that we are doing. We are helping the MSMEs through the diagnostic tool, the methodology, giving them the report so that they are prepared on this. So this is what I have to say from the sort of presentation perspective. And very fast in the next 2-3 minutes, I would like to cover that because we are also the secretariats to the B20 dialogue, which is happening on the ESG in business in India, where we have already received comments across the G20 nations. I think it would be good to see over there that there are 3 things as a priority that has come up. One is, of course, on the standardization, that what could be probably the ESG sort of a standard that India can follow, apart from what we are doing from a BRSR perspective, is ISSB standard 1, S1 and S2, the way that we should be moving forward with, as both David and John supported on that. How do we look into more Indianized version of this, where we can adopt this particular part? Second part, we have seen clearly that ESG has a great reflection in the global value chains, and this has to be driven across the geographies which are looking for the integrated supply chains worldwide, whether it is India or global south, how it can be aligned to it. And third important part that we have seen from the comments that have come in B20 is more towards the governance aspects, leading into something like the integrity, business ethics, how that can become an internal part of the governance mechanism. And also many sort of comments came in from the point of view of how the climate, business resilience, human rights, and all those issues could be also integrated. So I think that's what I've seen from the B20 perspective. And the last part of the discussion is on the assurance part. And I think we are still looking from CI perspective that how this complete things unfolds with the first year of BRSR that comes into the marketplace. How many companies take this assurance formally? How many of them really use the assurance standards that ISAI has brought out to. But one good thing is that at least the alignment part in India we have already done. And it is a matter of creating awareness through these webinars and other initiatives that SRSB are doing, that how do we reach to the assurance providers, which is either the members of ICAI, that how they can build their capacities to use this opportunity to use the assurance standards and get trained of them and become a part of the complete ecosystem. So I think this is what I have to say, and I pass it on back to Sanjeev ji, and I'm happy to answer any questions which are there later on. So over to you, Sanjeev ji, sorry.
Thank you very much, Shikhar. This was indeed very, very helpful, and we appreciate the support that we have from CII at the institute, and we really value this relationship. And together, at ICI, we are trying to basically give the best possible reporting and the assurance framework to the world. And I'm sure that under the leadership of our Honorable Prime Minister, Shri Narendra Modi ji, India will lead the way. Thank you so much. And with this, we'll have to end this session. Reason being that our technical speaker has met with a very serious medical emergency, Shailesh Tyagi. Will not be able to go through the technical session, but Shikhar has elaborated in detail about the BRSR. I'm thankful to Shikhar and thankful to David Mellon and John, both of them, and thankful to all the participants for participating in this very important webinar. Thank you, and stay tuned for future programs of the Institute of Chartered Accountants of India on this subject. Thank you.